this video, we're going to be discussing the difference between buying and selling options. As a newer trader, sometimes the lingo can get a little bit confusing. You'll hear things like short call, short put, long call, long put, and you might ask yourself, what does it mean? So let's dive into some of the lingo so that you can easily carry a conversation with your fellow option traders. All right, so buying versus selling. Now, this tends to confuse a lot of people in the beginning. Just like an equities position where you can buy and sell your shares, you can also do so with option contracts. However, the terminology around it can be a little confusing in the beginning. So what we're gonna do is we're just gonna walk through all of these, which are long call, long put, short call, short put, debit, and credit. This way you'll have a better understanding of what people are saying when they mention what their position is in the option world. So let's start with long call and long put. When you're longing calls or puts, what it means is that you are buying the option. Okay, so you are taking out a position on it where you've bought it, just like buying shares. So when you're long a call, let's say, you're buying the call, and this is a debit on your account because you are taking money out of your account to purchase the position. So it is a debit position. So you're buying the call and it's a debit. You are then long the asset. This means that you are expecting the asset to go up, right? So if you think that Apple's going to go up, you would buy a call, it would be a debit on your account because you'd be using money to purchase it, and then you would be expecting the asset or Apple to go up. Now, opposite of that, when you are long a put, this is where people get really confused, so pay attention. When you are long a put, you are buying the put contract. It is a debit on your account because, again, you're buying. So if, let's say it's Apple and you want to buy a put position on Apple, and let's say it's $3, you're taking that $3 or actually $300 out of your account to buy the put position. When you buy a put, you are short the asset. So pay attention to that. When you are long a put, you're actually short the asset. You are then expecting the asset to go down. Okay, so if you're long a call, you're expecting the asset to go up. And if you're long a put, you're expecting the asset to go down. You are buying the positions and you are debiting your account. So this is a debit position. Now, longing calls and longing puts, you have an infinite amount of money you can make on these. Your risk is what you've paid for the premium. So if the Apple contract was $3, or in other words, $300, because we have the 100 contract multiplier on it, then that is the most that you can lose in the position, right? You took out $300 from your account to buy the contract. If it doesn't do what you think it's going to do, the most you can lose on the position would be $300. Now, the most you can make on it is infinite. If Apple goes to 1 trillion tomorrow, you can make an infinite amount on these calls. Now, just remember, there is an expiration date, of course, but for the simple matter here, know that if you're long the call or long the put, the most you can lose is what you've spent on the contract, what you've debited from your account, and the most you can make is infinite. Now let's move over to a short call and short put. So opposite of the long call, long put, when you are shorting calls or puts, it means you are selling the option, okay? So when we sell an option, we credit our account. So if you are short a call, you are selling it, you're getting a credit. So rather than taking money out of your account to purchase the contract, what you're doing is you're selling the option contract and you're getting that premium. So if Apple is, say, $3, you get that $3 premium into your account. So it is a credit on your account. Now, when you short the call, you're actually short or neutral the asset. You are hoping the asset either goes down or is neutral and stays sideways. Now, let's explain what this actually means here. So if you sell a call or you short a call, and let's say this is your level up here, let's just say the level is 100, and you decide that you're going to short a 100 call up here. Now, what you want is the stock to either go down or stay neutral, meaning that it doesn't really matter how far it goes down, because when you credit your account, what you've sold, so when you short the call or you sell the call, you get that credit, and let's say the credit is $3 again, so you get a $3 credit on your account. That is the most you can make. And you make that money as long as when the contract expires, the asset is not above your strike price or below your strike price, depending on whether you've shorted a call or shorted a put. But basically, you just don't want it to get over that strike price of what you have sold the contract at and collected a credit for. So again, if you short a call and let's say you sell it up here, you have sold it, you've collected a credit, and then you are short or neutral the asset. Now, opposite of that, when we short a put, we are selling the put, we're collecting a credit on it. Again, so we've sold this contract to somebody else who's buying a long position and we've collected the premium on it. So we've credited our account. Now, when we do this, we are long or neutral the asset. So when you short a put, you're long or neutral the asset. So it's upside down to shorting the call. So you're looking for the asset to go up or stay in a range. What you don't want it to do is go below the contract that you've sold. So let's say here we've got, let's say it's $90 and you've sold this strike price contract for, $3 credit. If it stays above this level, you will be able to keep that $3 credit in your account, or technically when you get out of it, you might have to pay a little bit, but you've credited your account and that's what's going to be there. Now, we just don't want it to drop below the strike price that we've sold it at. So it can stay right above here, and as long as that contract expires, you will get that credit. Now, the major difference between longing and shorting your positions is that in the long position, like we talked about, you can make an infinite amount of money. Your amount of money that you can make is not capped. And the risk that you put down for it on your debit position is the most that you can lose. Now, let's flip that upside down, because for every buyer, there is also a seller. And on the selling side, so whether you're short a call or short a put, the most you can lose is infinite, and the most you can make is what you've sold the contract for. So basically, you have two people buying and selling, and the seller makes only the premium that they sold it for, and the buyer makes infinite amount of what they debited their account for. So let's just hop over to a blank canvas, and I'm just going to draw them out side by side just to go over it one more time so that you understand the difference between the two. So we'll put long on this side. So this is long. So when you're long a call, you're expecting the asset to go up. You are buying the contract. You are debiting your account because you've bought something. And you are, again, expecting the asset to go up. Now, if you are long a put position, you are buying the contract. You are debiting your account because you're taking money out of your account to purchase it, and you are expecting the asset to go down. So this is what long calls and long puts means. And again, you can make an infinite amount of money, and your losses are capped at what you spent on the premium. Now, on the other side, if you are short a call or short a put, it's going to be upside down, right? So if you are short a call, you're expecting the asset to go down or go sideways, right? If you are shorting a put, you are expecting the asset to go up or, again, chop sideways. Now, the most you can make on this position is what you've sold your contracts for. So if you've sold your contracts for $3, that's the most that you can make on the position, as long as the option contract expires with the stock above where you sold or below where you sold that premium. Now, the most you can lose is infinite. So unlike longing the position, you can lose a lot of money if you don't close your short position. And that is the difference between longing and shorting your calls and your puts. You should now understand the difference between buying and selling options. Hopefully we've cleared up some of the lingo. If you liked this video, please be sure to like and subscribe, and be on the lookout for future videos on options from the BBT team.